All right, Chapter 10, Demonstration. We're going to do a couple things with this chapter. What we're going to first do is purchase a bundle or a lump sum purchase of some assets. Then we're going to be working with depreciation for some different assets that companies may have other than plant assets. So we'll be talking about intangible assets and natural resources as well. So we'll be working with those as well. Okay, so on July 14th of 2015, Tulsa Company paid $600,000 to acquire a fully equipped factory. Normally when companies purchase a lump sum, they're going to purchase the building and all of the things that come with it. In this case, it's land, building, machinery, and land improvements. Now, land improvements are driveways, sidewalks, parking lots, landscaping, that kind of stuff. You will notice that I have the appraised value here. That's what the appraiser came in and said that the items are worth. It has a salvage value, a useful life, and the depreciation method. So we're going to be learning a different type of depreciation method. Before, we kind of went through straight line in Chapter 3, used it a little bit in Chapter 4. But then we're going to work with that a little bit more, and our units of production as well. Now with Chapter 10, there's not a serial problem. I'll mention that at the end as well. So you will not have a serial problem for this chapter. And we are also not going to be learning a third depreciation method, the declining balance method. We're only learning straight line and units of production. Companies don't use the declining balance method anymore. They just either use straight line or units of production. And then we'll have a ratio as well for this chapter. Okay, so when we purchase a bundle of assets, what happens is that the purchase price is going to be listed. In this case, it was $600,000 for all 4 assets. And then the appraiser came in and gave us an appraised value of each of these different items, and they all add up to $800,000. So we bought it for $600,000. It's worth $800,000. So very good purchase. Now, what happens with this appraised value is that we need to know what was the actual price for each of these assets out of the total that we paid for it. So that's what we're going to do first. And so with that, to calculate out the percent, because sometimes in your homework you're going to have to calculate out the percent, you're going to take the appraised value and divide it by the total to get the percent of the total value. So I'm going to take the land, $160,000, divided by the total of the appraised value of $800,000, and that gives me 20% or 0.20. For the land improvements, I take the appraised value divided by the total, I get 10%. For the building, $320,000 divided by the total appraised value, I get 40%. And then the machinery divided by the total value, I get 30%. Add those all together, and they need to equal 100%. So what does this actually mean? So what this means is that 20% of the cost that I paid, the $600,000, is going to give me my apportioned cost of my land. So to do that, we take the cost, $600,000, times 0.20, and I get $120,000. So the land actually cost me 20% of my purchase price, or $120,000. My land improvements, I take 600,000 times 0.10, and that's 60,000. So my cost for my land improvements out of the 600,000 is $60,000. For the building is 40%, so we take 600,000 times 0.40, and that's going to give me 240,000. So 40% of my apportioned cost is 240,000. That's what the building was. Machinery is 30%, So I'm going to take my total cost, $600,000, times 0.30, and that's $180,000. Now these four added together, the totals from what we just calculated need to equal the cost. So 20% of the appraised total, 20% of my total apportioned cost of what I paid is going to be $120,000. That's what I actually paid for the land. $60,000 is what I actually paid for the improvements. $240,000 what I actually paid for the building, and $180,000 what I actually paid for the machinery. So the percent of the total value is what you need to be able to do that. Please don't use the appraised value total. Use the bundle purchase cash payment amount for that. So to get the percent, you take the appraised value divided by the total appraised and then multiply it by the cost. Okay, so that is part one. Now, what we're going to do is we're going to compute the 2015 and 2016 depreciation expense for each asset, and then compute the total depreciation for both years. Alright, so let's go ahead and let's start with our machinery. We'll go with the machinery first, and then we'll do the other two. Okay, so when you go to do these, use your apportion cost. The cost of my machinery is $180,000. My salvage value, that's from my front page here. My appraised value for my machinery is, or salvage value, I'm sorry, is $20,000 for the machinery. Salvage value is $20,000. So I subtract that and I get $160,000. Now with my machinery, I am going to be able, this is units of production, not straight line, this is my units of production. We're starting with that first. So my expected number of units to be able to get out of the machinery is 10,000 units. So 10,000 units is what is expected to come out of that machinery. Now my depreciation per unit, how I calculate that is I take my depreciable cost of $160,000, divide it by my number of units, and that's going to give me $16 for my depreciation per unit. Now for 2015, and this is in your instructions, 700 units were produced, and in 2016, 1,800 units were produced. So in 2015, I have 700 units times $16 for my depreciation per unit, or $11,200. And then 1,800 units for 2016 times my depreciation per unit of 16, and that's 28,800. So with units of production, it's going to be based off of how many units the machine is able to produce. You divide that by the depreciable cost and you get the depreciation per unit, and then you'll be given the amount of units that the machine produced each year. You multiply that by the depreciation per unit, and that will give you your depreciation for each year. Okay, now let's go to your building. Now the building, again, we're going to use our straight line depreciation. Our salvage value is $100,000 and its useful life is 10 years. So for my building, $240,000, we again take it off your portion cost, $240,000. We're going to subtract out the salvage value, $100,000. That will give us $140,000, and that's divided by 10 years useful life. So my straight line rate is $14,000. That's for a full year's depreciation. Now for 2015, we only owned the asset for half of a year. We bought it on July 14th. So we can only depreciate it out for 6 months. So I'm going to take my $14,000, divide it by 12 months, but multiply by the 6 months that I owned it, and that gives me $7,000. Now, I realize that half of a full year is 7,000, but I wanted to show you this because a couple of your homework problems do have 9 months or 3 months, or, you know, they don't just have 6 months or a full year. They might have different months. So a full year is 14,000, half a year is 7,000, and then for 2016, it would be 14,000. Now, with our land improvements, again, we're going to take our cost, 60,000, take away our salvage value, which is 0. Useful life is 10 years. Again, the Mackers will tell us that. So, to get our annual depreciation, we take 60,000 and divide that by 10 years. So our depreciation is $6,000 per year. Now, for a half of a year again, we take 6,000, divide it by 12 months, times 6 months. So that's going to be 3,000 for a half of a year. And then again for 2016 for the full year, that's 6,000. So again, with the straight line depreciation, when it's a full year, it would be the same each year, each year, each year, each year. With your units of production, it's going to be different each year because of the number of units that are produced. Now, remember back with Chapter 3 and 4, we would journalize this for each individual year with depreciation expense and accumulated depreciation. So those are the two titles that we would use for each of the different assets. So for 2015, the total depreciation for the land is 3,000 and a full year was 6,000. The building, 2015, is 7,000, full year was 14,000. The machinery, 2015, is 11,200. And then the 2016 was 28,800. So we would journalize land improvements. Let's say we do 16. It'll be a $6,000 debit to the expense, credit to the accumulated. Building would be 14,000, debit to the expense, credit to the accumulated. And then the machinery, it'd be 28,800, debit to the expense, credit to the accumulated. Our total depreciation expense for 2015 is $21,200, and for 2016 it's $48,800. So those are the two different methods of depreciation. That's using our units of production for machinery and our straight line for our building and our land. Okay, so we have gotten through 1 and 2 here. We don't have to do number 3 because we don't have to deal with that one because we're not doing any connect problems, so we don't have to do that one. And so we're going to skip to number 4. So at the beginning of the year in 2017, Tulsa purchased a patent for $100,000 cash. The company estimated that the patent's useful life is to be 10 years. You will journalize the patent acquisition and its amortization for the year. So another type of asset besides our plant assets is what we call a intangible asset. Now, an intangible asset is going to be an asset in which a couple of different things fall here. So, intangible assets can be patents, which is an exclusive right granted to the owner to manufacture or sell a patented item or use a process for 20 years. It can also be a copyright that gives the owner the exclusive right to publish and sell a musical, literary, or artistic work during the life of the creator plus 70 years, although the useful life of most copyrights is much shorter. Franchises and licenses are rights that a company or government grants an entity to sell a product or service under specified conditions. So it could be like Firehouse Subs, or it could be McDonald's, or it could be the MLB or the NHL or the NFL or anything like that. So that's franchises and licenses. Then we also have trademarks and trade names, and those are a symbol, name, phrase, or jingle identified with a company, product, or service. For example, the Nike swoosh. We also have, the way that they write out Coca-Cola. If you look at cars, it can be their emblem, like the Chevy bow tie. Or it could be a jingle, like with the Big Mac, to all beef patty, special sauce, lettuce, cheese, pickles, onions on sesame seed bun for the Big Mac. Or it could be, a animal or a mascot, like Tony the Tiger for Frosted Flakes, or Toucan Sam for Fruit Loops, that kind of thing. So with those, the ownership is best established by registering a trademark or trade name with the government's patent office. And again, this is another type of asset that companies could have other than building, land, vehicles, improvements, that kind of stuff. All right, now with that, we're going to go ahead and purchase a patent for $100,000 cash. We will journalize the acquisition and then the amortization. Okay, so you do have another journal page. And I will put this as number 4. And this is going to be January 1 is when they acquired it. Or at the beginning of the year. We'll put the 2nd, because people probably aren't working on New Year's Day. Okay, so to acquire it, we put patent and cash. And this is for all intangibles that I just discussed. And this is to record purchase. Record purchase of patent. I will put the math here. Or no, I'm sorry, we don't need math for this one. The purchase is for $100,000. Debit the asset and credit the cash. Okay. Now, when we record the amortization, this is what the depreciation names are for an intangible asset. This is going to be the next year. Okay, so this will be December, or at the end of the year. So we'll put December 31st. This is going to be amortization expense dash patent. Actually, I should put that out to the edge. Patent. So that's going to be 1 year's worth of amortization expense. And then we have our accumulated amortization dash patent. So that will keep track of all the amortization for the patent during its lifetime. So this is going to be record yearly amortization. And I'll show you the math for this one. So it's $100,000 for the cost. It's a 10-year useful life. And so each year that we own this, it's $10,000 for the amortization expense debit, and our accumulated amortization credit, which I should put in the next line here, is our credit for our amortization. So it's just like our depreciation expense and our accumulated depreciation, but with our patents, copyrights, any intangibles, then we use amortization and accumulated amortization. Okay, now the last one is a natural resource. Late in 2017, Tulsa acquired an ore deposit for $600,000 cash. It added roads and built mine shafts for an additional cost of $80,000. Salvage value of the mine is estimated to be $20,000. The company estimated 330,000 tons of available ore. In 2017, Tulsa mined and sold 10,000 tons of ore. So, our natural resources are another type of asset that we have, and these are physically consumed when used. Examples are standing timber, mineral deposits, oil, and gas fields. These assets are soon to be inventories of raw materials after cutting, mining, or pumping. And with this, we use what we call depletion. That's the process of allocating the cost of the natural resource to the period when it is consumed. So natural resources, if you think about, they deplete. We can't grow more we can grow more timber. It just takes a really long time. We can't grow more ore. We can't grow more diamonds, things like that. So that's something that why it uses depletion for the natural resources. Okay, so this is going to be number 5 from our instructions. And this is late in the year, so I'll put December 31st for this. Well, let's use late in the year. We'll put November 1st. Okay, so for this one we purchased the ore deposit, and again it was $600,000 plus roads and mine shafts of $80,000. So to buy it, it's ore deposit and cash, record purchase of ore deposit. Now this is going to be the cost of it, which was the $600,000 plus the additional roads and mine shafts of $80,000. So we'll debit the natural resource $680,000 and credit the cash $680,000. All right, now to record the depletion expense, I'll put the titles in here. Depletion. This will be for December 31st. Expense, ore deposit, and then we have accumulated depletion dash ore deposit. So again, this could be for coal, it could be for timber, could be for oil, okay, anything like that. Record yearly depletion expense. Okay, now for this one, we're going to take the cost, $680,000, and subtract the salvage value of $20,000, and that's going to give us $660,000. Then we're going to divide by the number of tons that it is expected to be able to be mined out of the ore mine or ore deposit. So that gives us a depletion rate of $2 per ton. Now, 10,000 tons in our instructions was mined and sold. So times $2 during for the depletion rate. So that's 20,000. Depletion expense debit and accumulated depletion credit. So I'm sure that you won't have any problem with the math part. It's just going to be remembering the title. So remember with your intangibles, it's amortization expense and accumulated amortization. For the natural resource, it's depletion expense and accumulated depletion. And with our plant assets, it's depreciation expense and accumulated depreciation. So those are the different titles that you will use for that part of it. So again, we purchased a bundle of assets, and then we calculated out of the price that we paid for those assets how much we actually did pay out of the $600,000. We calculated out for the building and the land improvements the straight line depreciation, and for the machinery the units of production. Then we went ahead and we learned how to record the the amortization expense and the depletion expense, and then we reviewed depreciation for the 3 different types of assets that companies could have: intangibles, plant, and natural resources. Again, Chapter 10 does not have a serial problem with it, so you don't have to worry about that for Chapter 10 serial. Just again, work on your homework and make sure that you practice everything that is there for the homework.